high-income retirees avoid the Social Security tax trap. Picture this. You spent decades building a successful career, diligently paying into Social Security. Now you're finally ready to retire with the lifestyle you've earned. You're counting on those Social Security checks to help fund your travel, hobbies, or time with family. But then, out of nowhere, you're hit with a tax bill that slashes up to 85% of those benefits, potentially costing you tens of thousands of dollars over your retirement. If you're a high-income earner, this isn't just a what-if scenario. It's a very real tax trap that catches countless retirees by surprise. The worst part, it's completely avoidable. Wealthy retirees know the strategies to sidestep this costly mistake. And today, I'm pulling back the curtain to show you exactly how they do it so you can protect your benefits and keep more of your hard-earned money. Hi, I'm Josh Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. For nearly 20 years, I've helped high-income professionals and retirees build retirement plans that deliver confidence and peace of mind. One of the biggest shocks my clients face is discovering that their Social Security benefits, something they paid into for years, can be heavily taxed if they're not strategic. In this video, I'm diving deep into the Social Security tax trap, why it hits high-income retirees the hardest, and 7 proven strategies wealthy retirees use to minimize or even eliminate this tax hit. Whether you're nearing retirement or already retired, stick with me to learn how to make your Social Security work for you, not the IRS. Social Security is a cornerstone of most retirement plans, but for high-income retirees, it comes with a hidden challenge: taxes. If your income exceeds certain thresholds, up to 85% of your benefits could be taxable, eroding thousands of dollars from your annual income. Wealthy retirees don't just accept this, they use intentional strategies to protect their benefits. Here are 7 proven ways they avoid the Social Security tax trap and how you can start using them today. Number 1, understand the Social Security tax trap. The first step is knowing what you're up against. The IRS uses a formula called provisional income to determine how much of your Social Security benefits are taxable. Provisional income includes half of your Social Security benefits, your adjusted gross income or your AGI, like withdrawals from 401ks or dividends, and any tax-exempt interest, such as from municipal bonds. If your provisional income crosses certain thresholds, you owe taxes. For 2025, here's how it works for single filers. Below $25,000, no taxes on benefits. $25,000 to $34,000, up to 50% taxable. Above $34,000, up to 85% taxable. For married filing jointly, below $32,000, no taxes. $32,000 to $44,000, up to 50% taxable. Above $44,000, up to 85% taxable. These thresholds haven't been updated for inflation since 1983. So high-income retirees with pensions, investment income, or large IRA withdrawals often exceed $44,000 in provisional income easily. For example, a couple with $50,000 in Social Security benefits and $60,000 in other income could see nearly $40,000 of their benefits taxed at the regular income rate. This can cut deeply into the lifestyle you plan. Wealthy retirees don't let this catch them off guard. They plan ahead to keep their provisional income low, and that's what we'll unpack next. Number 2, leverage tax-free income sources. One of the smartest strategies is to draw income from sources that don't count towards provisional income. Wealthy retirees love Roth IRA accounts for this exact reason. Withdrawals from a Roth IRA or Roth 401k are tax-free and don't increase your provisional income. This means you can cover living expenses like housing or travel without pushing your Social Security into the taxable zone. For example, if you need $30,000 a year for discretionary spending, pulling it from a Roth IRA instead of a traditional IRA could keep your provisional income below the $44,000 threshold for couples, saving thousands in taxes. Another powerful tool is a health savings account, also known as an HSA. If you're still working or have an HSA from a high deductible health plan, contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses like Medicare premiums or long-term care are also tax-free and excluded from provisional income. Since healthcare costs often rise in retirement, HSAs are a double win. They cover expenses and help you avoid Social Security taxes. Wealthy retirees also use municipal bonds strategically. While their interest counts towards provisional income, it's often exempt from federal taxes, which can lower your overall tax burden. The key is balance, using the these tools to keep your provisional income below the taxable thresholds while maintaining your lifestyle. Number 3, time withdrawals strategically. Timing is everything when it comes to managing your provisional income. Wealthy retirees plan their withdrawals to minimize taxes year by year. For example, in the years before you start Social Security, often between ages 60 and 70, you might have lowered income, especially if you stopped working. This is the golden window to withdraw from traditional IRAs or 401ks at a lower tax rate, or convert some of those funds to a Roth IRA. Roth conversions are particularly powerful. By paying taxes on the converted amount now, you reduce future taxable withdrawals, which lowers your provisional income when Social Security kicks in. Imagine converting $20,000 a year from a traditional IRA to a Roth in your early 60s. This could save thousands in Social Security taxes later by keeping your provisional income below the 85% taxable threshold. The catch? You need to plan carefully to avoid jumping into a higher tax bracket today. Wealthy retirees work with advisors to create multi-year withdrawal plans, smoothing out their income to stay below the key thresholds and maximize savings. 4, delay Social Security benefits. Another tactic wealthy retirees use is delaying their Social Security benefits. For every year you delay past your full retirement age, usually around 66 or 67 depending on your birth year, your benefit increases by up to 8% until the age of 70. A larger benefit means you might need less income from taxable sources like IRAs, which keeps your provisional income lower. Plus, delaying can reduce taxes in the early years of retirement. For example, if you retire at 62 but wait until 70 to claim Social Security, you can live off other accounts like Roth IRAs or cash reserves without triggering Social Security taxes. This also gives you time to execute Roth conversions or harvest capital gains at lower rates. Data from the Social Security Administration shows that only 4% of retirees delay until the age of 70, but wealthy retirees are more likely to do this because they understand the tax advantages. The trade-off? You need enough savings to bridge those years, but for high-income retirees, this is often a smart move. Number 5, use a bucket strategy for income. Wealthy retirees often use a bucket strategy to manage income and minimize taxes. This means dividing your assets into different buckets based on when you'll need the money. Bucket number 1, cash or short-term reserves for 0 to 2 years of expenses. Think high-yield savings or money market accounts. This covers your immediate needs without selling investments or triggering taxable income. Bucket number 2, conservative investments like bonds or fixed annuities for 3 to 7 years. These generate steady income and can refill your cash bucket without pushing your provisional income too high. Bucket number 3, growth assets like stocks or real estate for 7+ years. These grow over time and are tapped later when you can better control the tax impact. By structuring your income this way, you avoid relying solely on taxable withdrawals from IRAs or 401ks, which can spike your provisional income. For example, a retiree might use cash and Roth withdrawals in early retirement to keep income low, then tap an annuity or bonds later when Social Security is in play. This flexibility is a hallmark of wealthy retirees' planning. Number 6, incorporate charitable giving. Strategically charitable giving can be a powerful tool to reduce Social Security taxes. Wealthy retirees often use qualified charitable distributions, also known as QCDs. With a QCD, you direct up to $100,000 per year from your traditional IRA to a qualified charity. This satisfies your required minimum distribution and excludes the amount from your taxable income, which lowers your provisional income. For example, if you're required to withdraw $30,000 from your IRA, but donate it via a QCD, that $30,000 doesn't count towards your provisional income, potentially saving you thousands in Social Security taxes. Another strategy is a donor advised fund, also known as a DAF. You can bunch several years of charitable giving into one tax year, maximizing your deductions and lowering your AGI, which reduces your provisional income. Wealthy retirees don't just give to make an impact, they do it strategically to optimize their tax picture. Number 7, work with a professional for tax smart planning. The final strategy is perhaps the most important. Wealthy retirees don't go at it alone. Navigating the Social Security tax trap requires coordination between income planning, tax strategy, and investments. Mistakes like withdrawing too much from a 401k or mistiming a Roth conversion can cost thousands of dollars in unnecessary taxes. Wealthy retirees work with advisors and CPAs to review their income sources annually, project a provisional income over multiple years, adjust withdrawals based off tax thresholds and market conditions, coordinate with tax professionals to avoid surprises. For example, an advisor might recommend delaying Social Security while converting IRA funds in low-income years and then shifting to Roth withdrawals once benefits start. This proactive approach ensures every dollar is working to minimize taxes and maximize lifestyle. By planning ahead, wealthy retirees turn Social Security into a reliable income source, not a tax burden. If you're a high-income earner with 5 to 10 years of retirement or already retired and want to keep more of your Social Security benefits, it's time to act. Don't let taxes erode the benefits you've worked decades to earn. Book a free consultation with me today using the link in the description below. We'll sit down and review your income sources, tax picture, and retirement goals to build a personalized plan that minimizes taxes and maximizes your lifestyle. Spots are limited and they fill up fast, so don't wait to secure yours. Plus, hit that subscribe button for more strategies to retire smarter and protect your financial future. Let's make Social Security work for you, not the IRS. Book your call now. Thanks for watching, and if you found this valuable, share it with someone who needs to hear it. I'll see you in the next video with more tips to secure your future. Stay strategic, and let's build a retirement that's as strong as your hard work.